Hello, welcome to this short session today. We're going to talk about financing concepts. This comes out of your financing section in your common law national portion in preparation for your state exam. So we're going to look at financing concepts, primary market, secondary market. We're going to see how money's lent. Can a bank run out of money? You ever ask yourself that question? Can a bank ever run out of money? How do they produce money to be able to lend out again? So we're going to look at these concepts here in this short session. My name is John Enzing. I'm a certified real estate instructor in both Louisiana and Florida. My specialty is to teach you, prep you, private tutor for the state exam. Non-credited hours. All you have to do is go to privateturingsession.com. That's privateturingsession.com and book an appointment. Or you can just email me at john.enzing@gmail.com. All right, let's get into this financing concepts. So what are we talking about here? Well, let's look at the sources of financing. How does money come about to be lent? So we got two sources that we're going to look at. One's called the primary market. The other one's called the secondary market. You need to have a really good, clear concept and a vision or a picture of what this is. And I've got some pictures to show you. So the primary market, this is where loans are originated. Here's your Chase banks, your Capital Ones, Whitney, any local bank, regional, or even national bank is where loans are originated. They're labeled under savings association, commercial banks, and credit unions. So that's where money is lent out. Now, there's two terms you want to know about. The first one's called intermediation, and the second one is called disintermediation. These terms you have to have a clear vision on for the state exam test, and it also gives you a clear understanding how money works. When we say intermediation, we're talking about a bank, and let's just use Chase as an example. Chase has a flow of funds available to lend out. In other words, they've got a high inventory of capital, okay? And so they got a lot of money they can lend out for home loans. Disintermediation is when all the money is lent out and there's no capital for money to flow. So you don't have any money to lend out, okay? So intermediation, you got a flow of funds. Disintermediation, you don't have a flow of funds because all the revenue or capital is tied up in mortgage loans, okay? Want to know those two terms, very important. Now, the secondary market, this is where the loans are bought and sold. I'm going to show you a little bit more of a detailed diagram when it comes to how the cycle of money works. So we're talking about the secondary market. This is not, pay attention, not where loans are originated, okay? This is the market that buys the loans from the primary market, okay? And they warehouse them. They're called warehousing agencies. Think of a big warehouse, and you put all these loans in the warehouse. And so the secondary market is the one that is going to just receive and service the loans, but they buy them off the primary market, okay? Now, you got three secondary markets. One of them is called Fannie Mae. Government-sponsored enterprise is the key word you want to know for the state exam. They're not private. They're not government-owned. It's government-sponsored enterprise, okay? So they buy and sell FHA and VA loans, okay? That's what they do. And conventional. So all three loans, conventional, FHA, and VA loans is what they buy and sell, okay? So all three loans, that's very important that you understand that. Ginnie Mae is government-owned, okay? They basically have special assistance programs, government loans, FHA, VA, USDA, that are special assistance programs to low-income earners for, again, FHA, VA, and USDA government loans to purchase property, okay, called Ginnie Mae. Freddie Mac, government-sponsored enterprise. So Fannie Mae is GSE, government-sponsored enterprise. Ginnie Mae is government-owned, and Freddie Mac is government-sponsored enterprise. Freddie Mac only buys conventional loans, okay? Now remember, the secondary market is what buys the loans off the primary market. And I'm going to show you a diagram that illustrates how the money flows, okay? So you want to know the sources of financing, the primary market and the secondary market. Now, does a bank ever run out of money? We're going to start with this diagram. So you got to ask yourself this question: does a bank ever run out of money? Gosh, that's a good question to ask yourself, right? And the answer is yes. If I say, hey, look, if you're living in Florida, for example, and I ask you to drive to New York City on one tank of gas, do you think you can make it? Absolutely not. you're going to have to fill up several times en route to make it to your destination. Same concept comes when it comes to a bank. Does it ever run out of money? Because they lend out, they lend out, they lend out, right? We're talking about mortgage loans. We're in the real estate business, so we're talking about home loans. They keep lending out these home loans. Do they ever run out of money? And the answer is yes, they can run out of money. So this is where the primary market and the secondary market play a key role. Remember, the primary market is where the loans are made. We saw the term intermediation. The bank's full of money. I'm ready to lend out home loans. Here comes all the buyers and the borrowers to buy the homes. I get to a point where I lend out all that money. I don't have anything left. I have disintermediation, okay? And so what ends up happening is when I'm out of money, where am I going to get other money to be able to re-lend out? And that's where the secondary market comes into play. So does the bank ever run out of money? Can they run out of money? Absolutely they can. So here I've got a bank and I've got the word intermediation, right? And let's say we have a gauge on this bank, like a gas tank, and right now the bank's full of money, okay? So they've got a load of money in this bank ready to lend out. And then all of a sudden, here comes a buyer or many buyers. Let's just make not just this one person, say it's many, hundreds and hundreds and hundreds, right? So all of a sudden, disintermediation can come into play. And now they've tied up all their money to these people that bought homes. So now what? What happens next? Okay, we're out of money. I've tied them up in the home loans. Here's how this process works. So the big picture when it comes to home financing, again, here's a quick review. In the red circle, we have the primary market. Those are savings association, commercial banks, credit unions. These are where loans are originated. Remember, we're full of money as a bank. Here comes all the buyers, and we're going to lend out all this money, okay? There they are. Look at them, by the hundreds and hundreds and hundreds, and maybe even thousands. So all of a sudden, we go from intermediation. These people have all our money now. It's tied up into capital. So what do we do as a bank, as the primary bank, and we're into a disintermediation, or our gas tank is empty? What we end up doing is we turn to the secondary market, okay? We turn to the secondary market. We've got all these loans, millions and hundreds of millions of dollars worth of loans, and now we look at Fannie Mae, Freddie Mac, Ginnie Mae, and we say, here, we got AAA credited loans. Why don't you buy these, and you can warehouse them and collect the interest on the remaining balance? And they say, sure, these are good loans. We're going to buy these loans from you. So they take them and they warehouse them, and they're going to collect the interest on and service out the loan. Well, now the primary bank has received all this capital, again, from the balance of these loans, hundreds of millions of dollars. And what do? They turn around and they lend it out again. So they go from a disintermediation. You can see the people at the bottom left, disintermediation. Okay, no more money. Now they turn to the secondary market, and the primary market says, look here, buy these loans. And the secondary market says, good, I'll buy these loans, I'll service them and give you the money for them. And now the bank is intermediation. They got money again, okay? Now, you may say, well, John, what about the secondary market? Well, they're collected on the interest of the loan, but they can take a portion of those loans and sell them to banking investors, okay? Wall Street investors. Anybody that's want to invest in these loans as mortgage-backed securities, okay? So the secondary market can sell the loans to banking investors as mortgage-backed securities or stocks, basically is what it is. And then they collect the money, and they got money now to turn and buy from the primary market, okay? So the money kind of flows in that picture there. Now, the other way that the primary market can, this is one way through the secondary market, selling the loans to the secondary market is one way that they can establish and get from disintermediation back to an intermediation or full of money to lend out. Other ways is deposits. What do you mean by that, John? Well, deposits, you see all those people at the bottom left? Those people may come into the bank and open up savings accounts. They may buy CDs, all kind of investment products, okay? So they're putting money into the bank. So that money's taken and lent out. Also, the primary bank or the primary market, all the banks in the primary market can go to the Federal Reserve. Okay, the Federal Reserve System is in place to be able to lend money to the banks through the federal district banks. And you see the map at the top right. You can see Louisiana, part of our Mississippi, part of Louisiana, Alabama, part of Tennessee, Georgia, and Florida is in District 6. Atlanta is the headquarters for District 6 of the Federal Reserve. So all those banks in that area can borrow money from the Federal District Bank in Atlanta, right? And so they borrow it at a reduced price, okay? A real reduced price. And we're talking, it can be millions and millions and millions of dollars that are bundled or put in lots of mortgage loans, and they borrow it at a reduced rate, and then they turn around and mark up that rate to be able to lend out. So that is another source that the primary market can get money is through the federal district. So there's really three sources. The secondary market, where their loans are sold, deposits, where people just come in and open up accounts and put money into it, or buy investment products from that bank, and they can borrow money from the Federal Reserve. So here's the question: Can a bank run out of money? And the answer is yes. So there has to be a cycle and a way to be able to reproduce money and be able to re-lend out. Okay, just like trying to make it to New York City on one tank of gas, that's not going to happen. You got to refill up a bunch of times. Okay. And listen, I hope this little section gave you a vision and a good picture of how the financing concept works when it comes to intermediation, disintermediation, the purpose of the primary market and the secondary market. Okay, very important concepts to understand. Again, if you need help in your clearing up your content that you may not understand, go to privateturingsessions.com, privateturingsessions.com. Good luck on your exam. Bye for now.